With the recent market downturn and economic uncertainties, are you concerned about your investment portfolio? Do you have a strategy in place to protect yourself from further downside risks? Today, I will address these concerns by sharing how the dividend ETF SCHD can help safeguard your investments. I will explain why I'm doubling down on SCHD after I added it to my ETF portfolio 4 months ago. First, let me recap why I bought SCHD in the first place. As a retiree, I prioritize stability in my ETF investment portfolio with dividends serving as one key income source. SCHD aligns well with these goals for me personally. SCHD is a passively managed ETF with a relatively low expense ratio of just 0.06%. It offers an impressive 3.7% annual dividend yield to investors, which is 3 times that of any S&P 500 index ETFs. If you would like to learn more about SCHD, I recommend watching this in-depth video. Now let's take a closer look at how SCHD has performed against VOO, my favorite S&P 500 index ETF, and the Nasdaq 100 index ETF, QQQM. Since early December of last year, when I first purchased SCHD, its price has dropped by 3.9%, while VOO's price fell 6.1% and the QQQM has declined 7.4%. However, with 2 dividend payments, one in December and another expected at end of March, SCHD provided an additional yield of roughly 1.85% compared to VOO's 0.6%. This brings SCHD's total return to around -2%, outperforming VOO's -5.5% over the same period. As we enter the new year with tariff uncertainties and the increased possibility of US economic slowdown or even a recession, the benchmark S&P 500 and Nasdaq 100 have come in and out of the correction territory from their recent highs. Year to date, SCHD has gained 1.8%, while VOO is down 2.7%, and QQQM has suffered the most, losing 5.2%, not accounting for dividends. If you held SCHD, not only were you protected from the recent market crash, but you even generate a gain so far in 2025. Why SCHD has been performing well? This comes down to the defensive nature of the companies included in the ETF. The top 3 sectors, financials, healthcare, and consumer staples, make up 50% of SCHD's holding. The US economy is consumer-centric, with consumer spending contributing close to 70% of GDP. When consumer sentiment drops due to a pessimistic outlook, people tend to cut back on discretionary items, such as electronics, large appliances, vacations, and home improvements. However, people always need to spend on essentials like groceries, medications, and doctor visits, which is why healthcare and consumer staple sectors perform better in a slower economy. On the other hand, financials such as banks and asset management firms tend to underperform during recessions due to lower loan demand, higher default rates, and drop in asset value they manage. Looking ahead, the good news is that a recession is not imminent. According to this month's Federal Reserve meeting, the committee indicates a slower economic growth and a higher core inflation by year-end, but a severe downturn is unlikely. Additionally, with the new administration's focus on deregulation, financial companies could benefit from an increase in business deals like mergers and acquisitions and IPOs returning to the market. This is why SCHD could continue to perform well in a slowing economy, giving its concentration in the defensive sectors while potentially offsetting any weakness in the financials as deregulation efforts positively impact businesses and major investment banks. As the economy goes through boom-bust cycles, your investment portfolio must be structured accordingly to play defense during contractions and offense during expansions. Let me replay a clip from my earlier video where I discussed the 3-pronged ETF strategy. I already have VOO, which tracks the broader growing economy, and QQQM, which plays offense by riding the wave of AI transformation. Now, SCHD plays defense, focusing on financially strong, dividend-paying companies. This is my three-pronged ETF portfolio strategy, designed to enhance both growth and stability in the long term. Some may argue that investing solely in QQQM and SCHD provides a sufficient balance between offense and defense. However, as shown in the diagram, a portfolio without VOO misses a significant portion of the S&P 500 companies. Therefore, I consider VOO the first building block for anyone's core ETF portfolio, followed by other funds to complement it. To effectively manage your portfolio, for example, you could allocate 50% to a core foundational ETF like VOO, 20% to a growth ETF like QQQM, 20% to SHD, and 10% in cash. During an economy expansion phase, typically signaled by the Federal Reserve a beginning of an easing cycle or pausing its current tightening cycle, you could increase your QQQM's allocation to 30 to 35% while reducing SHD to 5 to 10%. Conversely, when economy contrasts, increase SCHD's allocation to 30 to 35% and reduce QQQM's to 5 to 10%. A similar approach can be applied between VOO and cash as well. Because we're still technically in an easing cycle, though at a slower pace since last December, and the Fed plans 2 additional rate cuts by year-end, I will take a slightly less aggressive approach in rotating from offense to defense. For instance, increase SHD's allocation to a moderate weight of 25 to 30% instead. Even if the current market correction deepens to a new bear market, stay invested by playing defense. Bear markets are relatively short-lived, lasting an average of 9.6 months compared to the average length of 4.9 years for bull markets. By adopting this three-pronged ETF strategy with a proper allocation management, your portfolio will be well positioned for any economic condition, maximizing returns while safeguarding your investments during difficult times. Prepare for the worst but hope for the best. Good luck and see you soon in the next video.